Credit cards may look simple, but they function fundamentally differently from any other payment method. Unlike cash, checks, or debit cards where you spend your own money immediately, credit cards let you borrow funds that you'll repay later. This subtle timing difference completely transforms how we spend and manage our finances. It's essential to view your credit card as a payment method tied to your current income, rather than as additional funds or a way to spend beyond your means. Stick with me till the end. This is advice you won't want to miss. In this channel, we'll break down everything you need to know about credit card success made easy, one lesson at a time. A credit card is more than just a piece of plastic in your wallet. It's a sophisticated financial product that provides a line of credit extended by an issuer after verifying your creditworthiness. While traditionally these come as physical cards with embedded technology, many of us now add these cards to mobile wallets for convenience. But beneath this simple exterior lies a financial mechanism that functions quite differently from other payment methods. Credit cards operate as revolving lines of credit, a unique and flexible form of borrowing. You are given a credit limit, which is the maximum amount you can borrow, but you are not required to use the full amount. As you repay what you have borrowed, that amount becomes available to use again. The cycle of borrowing, repaying, and borrowing can continue indefinitely, hence the term revolving. There is no set date by which you must pay off the entire balance. As long as you make the minimum payments required by the credit card issuer, you can carry a balance indefinitely. You have the option to pay the statement balance, the minimum payment, a small percentage of your balance, or any amount in between. However, you will incur monthly interest charges on the remaining balance if you do not pay off your balance by the due date. The account remains open and usable unless you choose to close it, or the issuer closes it due to factors such as account inactivity, policy violations, or credit issues. Now, let's understand the crucial difference between credit cards and other payment methods like cash, checks, debit cards, or mobile payment apps. When you use a credit card to make a purchase, you're not spending your own money, a concept that's essential to grasp. Instead, you're borrowing money from a financial entity. The transaction works like this. The cardholder presents their card or enters the card details to buy goods or services at a point-of-sale terminal or online checkout. The merchant's point-of-sale system sends the transaction data, merchant ID, transaction amount, date, and card details, to the merchant's acquiring bank or payment processor to manage the payment details. The acquiring bank forwards the authorization request into the credit card network. For example, Visa, MasterCard, American Express, or Discover. There, real-time risk engines and AI-driven fraud models analyze the data, checking the transaction details, location anomalies, and known fraud patterns. The credit card network routes the authorization request and the risk assessment to the credit card issuer, the financial entity that issued the card. The issuer combines the risk assessment with the cardholder's account history and available credit, then decides to approve or decline the transaction. The issuer's decision, and an authorization code if approved, travels back through the credit card network to the acquiring bank and then to the merchant's terminal or checkout page. The merchant and cardholder immediately see approved or declined. If approved, the cardholder gets their receipt, paper or digital, and the sale is complete. Despite all these steps, the entire authorization leg happens in a second or two, anywhere in the world where credit card networks operate, unless a severe communication issue affects any step of the process. Finally, often in a batch run, the merchant's acquiring bank submits all approved transactions to the credit card network, which nets debits and credits across issuers and acquirers. The issuing entity transfers the funds, minus interchange fees, through the network to the acquiring bank, which deposits the merchant's share into its account. Lastly, every transaction you make is recorded on your account during your billing cycle, which typically lasts 28 to 31 days depending on the month. At the end of that cycle, your credit card issuer sends you a statement showing all posted charges and your statement balance, along with a payment due date. From the statement date, you then have up to 21 days, your grace period, to make a payment. I'll delve into these details in another video in this series. Beyond standard purchases, your credit card typically allows you to withdraw cash from your account or transfer debt from another credit card, both options that usually come with additional fees and interest rates. In contrast, all other payment methods involve spending your own money immediately at the point of purchase. With cash, you're physically handing over currency from your wallet. With checks and bank transfers, you're instructing your bank to move money from your account to someone else's. With debit cards and mobile payment apps, you're electronically transferring funds directly from your bank account to the recipient. The key distinction between credit cards and all other payment methods comes down to timing, when your own money becomes involved in the transaction. With credit cards, you use borrowed money at the point of purchase, and your own money only enters the equation when you pay your credit card statement later. You're essentially paying for purchases you made in the past. With all other payment methods, your money is used immediately at the point of purchase. You're paying for current purchases in real time. This timing difference might seem subtle, but it fundamentally changes how we think about spending. When using a credit card, it's remarkably easy to lose track of your cumulative spending throughout a billing cycle. When the statement finally arrives, many people are shocked by the total amount due. If you don't have enough money to pay the balance in full, you begin accumulating debt that becomes increasingly difficult to escape as interest compounds. It may seem obvious, but never forget this essential point. Every time you use a credit card, you're borrowing money that you'll need to repay, and you must be prepared for that. Now that we understand how credit cards function differently from other payment methods, let's examine the benefits they offer when used responsibly. First and foremost is convenience. Credit cards, like debit cards, are widely accepted and offer a convenient way to make purchases without carrying cash. However, for certain transactions, credit cards are actually the preferred payment method by merchants and service providers. Consider car rentals and hotel reservations, where a hold is placed on your account to cover potential additional charges. Credit cards handle these situations seamlessly. Second, responsible credit card use is one of the most effective ways to build your credit history and improve your credit score. This becomes critically important when applying for major loans like mortgages or auto financing. A good credit score can secure a low interest rate, making your loan more manageable. In contrast, poor credit will likely lead to a denied application or, if approved, a high interest rate that can strain your finances. Additionally, many landlords check credit scores for rental applications, and some employers review credit reports during hiring. Needless to say, a poor credit score will not work in your favor. Third, many credit cards offer valuable perks and rewards on all your purchases. An appealing benefit you wouldn't want to miss, right? Check out our 3-part video series on perks and rewards to discover what credit cards can offer you. Fourth, in genuine emergencies, a credit card can provide an immediate financial cushion. In situations where unforeseen expenses arise, be it a sudden medical bill, urgent car repairs, or another unexpected crisis, the ability to access funds instantly can be a critical safety net. This immediate access to credit can help alleviate pressure in the short term, giving you time to organize your finances or reach other funding sources. However, it's important to view a credit card as a backup mechanism rather than a primary resource. Ideally, this emergency use should be supported by a dedicated emergency fund, so you're not solely reliant on borrowing when you face an unplanned financial challenge. Fifth, Credit card statements do more than just list transactions. They break down your spending into specific categories such as dining, groceries, travel, utilities, and more. This organized approach allows you to see exactly where your money is going, making it easier to cross-check with your budget. With such insight, you can quickly spot areas where you might be overspending and adjust your budget accordingly. Over time, these detailed reports help you track progress toward your financial goals and can inform smarter money management decisions, all while reinforcing financial discipline and accountability. In summary, using a credit card wisely is a powerful way to manage and pay for purchases with confidence. However, it's crucial to see your credit card as a payment method tied to your current income, not as extra money or a tool for overspending. This mindset is the cornerstone of responsible credit card use. If you found this information helpful, explore the videos below to continue your journey toward credit card mastery. Don't miss out. Remember to hit the like button and subscribe to our channel so you stay updated on the latest tips and insights. We'd love to hear your experiences with credit cards. Share your story in the comments below. Thank you for watching.